Welcome back, ladies and gentlemen. You're watching Startup Central, and SEBI's amendments to angel funding, including the mandate for accredited investors-only funds, could bring an end to angel investing itself, and that's the word that's coming from Chairman and Managing Director of TVS Capital Funds, Gopal Srinivasan. In an exclusive chat with ET Now's Jude Saneth, the TVS Capital Funds boss has also laid out his top sectoral picks for private equity, and he said that he's a huge Trump fan. Here's a slice of that conversation. Take a look.
SEBI no longer has to take the special accountability for investor protection. What they're saying is, boss, if you're accredited, don't complain. Right. It's your choice, it's your life. You have every right to take risk, every right to make money, every right to lose money. Angel funds give you that ability because SEBI, if you notice, an accredited investor funds is removing limits on the number of investors in a fund. Yes. So, if you see in a very careful regulatory mindset, an accredited investor angel fund can have any number of investors. So you can offer this investment to any number of people and not break, quote unquote, any law. Now you and I can question whether this 200 has any meaning. I personally think it doesn't. Right? It had meaning when it was made, but the country is changing. Absolutely. Right? And so that is the accredited investor logic in the angel fund. Right. But let us take one more thing, Jude, if I may. Sure. They've also come with an accredited investor-only fund in the same breath as the angel investor fund. And in the accredited investor-only fund, what they've said is, if every participant is an accredited investor or a QIB, a qualified institutional buyer, they're saying we are making the rules very, very relaxed. So in other words, it becomes more amenable for good fund management. Today, we are restricted as fund managers because of SEBI's fear of investment protection, investor protection. For example, there's something called priority distribution. Today we are sitting here in Startup Singham. They talked about people investing in companies. One person may say, I don't want any returns, just give me back my principal, I am doing some good for society. Another person say, boss, give me 4-5% return, preferred return, but give it to me in the beginning, I'll go. Let others enjoy the rest. Those are all things which SEBI has views on, which in my mind, they have views on because they want to do investor protection. But actually, in my mind, they shouldn't have views on. Right. It's a free choice. Right. So I think we are now moving in the direction with the accredited investor-only funds to get the same kind of fund structures that exist across the world and, ironically, Jude, exist in IFSCA. In IFSCA, the AIF rules allow all these things because nobody there is worried about investor protection. Absolutely. So this is a journey of India's evolution in the capital markets, allowing more and more people to participate in riskier asset classes in a manner where the regulator feels they are fulfilling their ambition of, or not ambition, but their mandate of investor protection. So this is the trade-off that's actually the underlying trade-offs that are going, right? Sure. And I would say that SEBI whole-time member Anant Narayan, the current chairman T.K. Pandey, and the previous chairperson, Madhavi Puri Buch, have been incredibly driven to make these liberalizations happen and see India grow. We understand that they have their constraints. We may not necessarily agree with all their constraints, but we know they have those constraints. And within that, they're doing a fantastic job.
So what exactly is all set to change, Mr. Gopal, as far as angel funding goes? I know for a fact that the limits on investments by way of the angel fund itself, or the proportion that angel funds will have, is all set to go up to 100 crore rupees. But although the fact that accredited investors means that a fund will have to wait for all these investors to come on board before going about launching. So cards on the table, what is set to change?
I don't think many people will make angel funds. They will just get people in groups to invest directly in the companies, is what I think. Angel funding will grow. I'm not sure angel funds will grow. The reason is all these limits, which in all good intentions have been put as what is the check size, number of years, etc., which are there in the angel fund rules, right? I think there's a tenor, maximum tenor of the investment. You know, practically people say why am I interested in all these things? What am I getting? When there was angel tax, angel funds are very attractive. Because now if I invested through angel fund, angel tax didn't apply. Now that is also gone.
So going forward then, what do you think would be the more viable route for investors to get in? Would you see an influx of more private equity investments? Where do you see this going from here in terms of funding itself as far as a startup or a new venture is concerned?
I think funds, because people need a good fund manager in terms of the volume of money. The funds will grow The accredited investor-only fund will grow even more because that gives a lot of flexibility to the fund manager to do what's right for the investor. And I think there'll be the insurance pools are growing. Like in our own fund right now, as I was mentioning, more than 25% is insurance money. When we started, we had one insurance company. Insurance today, life insurance has 120 trillion rupees worth of pools. Even at 5%, the 6 trillion. And that's growing at 10% a year. So I think you'll see a lot more. The fund growth in India minimum has to be 5x. Today we have 4.5 trillion rupees in pools, including invested. That needs to be about 25 trillion.
Right.
And I think India is on its way.
Right. Since I have you here and we're talking about funding itself, which areas or which verticals do you see holding the most promise when it comes to overall funding? Which ones are you the most excited about?
I am actually a big believer in what I call alpha from depth. I think as fund industry scales, people doing the so-called spray and pray is dangerous, which is opportunistically I see this. I'm investing in a peanut company one day, I'm investing in a SAP implementer the other day, which some companies have actually done. I'm giving you a live example, is something I think is gone. I think what we need to do is to understand the sector, understand it deeply, build an ecosystem of people in the sector, and then basically focus on that sector. Given that, if I just go by data, the four popular sectors in India, financial services number one, maximum money goes there, 30-35%. Technology, IT services, now AI, BPO, maybe about 15-20% goes into that area. Healthcare, obvious, and consumer. Because a lot of what they call tech is actually consumer. I mean, is Swiggy and Rapido tech or is it consumer? To me, it's consumer. Right? And these are the big four. So we have chosen two, which is basically enterprise software and services and financial services, about 40-45%. But we go deeper and deeper and deeper and understand the sector well, put together strong advisory teams of eminent CEOs who are retired and take their help in building enduring businesses. Right? So I think more than which sector, I would say, for the capital that you have, make sure you understand that incredibly well. That is the most important thing.
Absolutely.
Not which sector you choose.